Sorry. Happy Friday and good morning. We are half an hour away from the opening bell. Hong Kong, Shanghai, and Shenzhen. You're watching the China Show. I'm David Ingles with Annabelle Droulers.
Our top stories: Asian stocks edging higher as President Trump says buy ahead of US-China trade talks, signaling tariffs could fall if discussions go well.
Now, Trump also unveiling a framework trade deal with the UK, but details are fairly scarce, and his Commerce Secretary tells Bloomberg agreements with Asian economies will take much longer.
Plus, tea with just a side of sympathy. President Putin hosting China's Xi Jinping in Moscow, emphasizing their alliance as they seek to challenge the US-led world order. All right, taking a look at the market action this Friday morning, we're actually moving a bit higher, but tracks really the sentiment we've had across the course of this week. Only one day in the red so far. What is driving this, of course, is this anticipation or optimism that we're getting off the back of these trade deals. So overnight, of course, that was the deal that the US inked with the UK. The read-through on that is maybe the details are looking a little bit scarce, and maybe it's more just a bit of a show. But at the same time, you do see traders that are sort of clinging to this and also looking ahead to these negotiations that are about to get underway between the US and China as well. So that is really what's driving market sentiment so far this morning, particularly being felt or noticeable in the Nikkei 225 up 1%. Also got Taiwan again coming online 1% in the green. What else we're tracking, of course, is how we're seeing it playing out cross assets. You have seen a gold rising, for instance. We saw Treasury yields spiking the session. They're fairly steady so far this morning. Golden Dragon Index, again, really reflecting this trade optimism, rising 1% overnight. And looking ahead to what we see in futures ahead of the open this morning, we are looking for a little bit of a brighter spot, or rather actually now fairly steady. But some other things on the agenda, Dave, we're watching for as well include trade data that's going to be coming out later this morning, plus actually some more negative earnings from the major chip names as well.
Yep, just making, I guess, in the spirit of the news in the Pope, of course, Habima's trade data, I think, is how we say that as well in Latin. All right, anyway, yep, as Belle was pointing out, there's lots on the docket today. Of course, we're just wrapping up, and we'll get you all the takeaways and, in fact, go deeper into the conversations around the trip out of Russia. Will China buy more Russian gas and Russian energy? How does this affect any deal as far as Ukraine is concerned there? In terms of sectors to watch, a lot, in fact, today on the docket, because you do have, of course, property and property bonds, high yield and junk bonds on the back of this reporting that we had here, that China is mulling. There's almost a near overhaul of how the housing market, at least how they sell property and apartment units. We'll get to that in a moment, because we do have some reaction coming through as well, coming out of our folks at Bloomberg Intelligence. Right, now in terms of earnings, which came through yesterday, we are getting, we'll be getting the reaction today, and also some downgrades coming through. So you have BNP, and of course you also have, I think Morgan Stanley came out on Hua Hong and cutting that as well to underweight. HIBOR is very much in play. So this is both the Hong Kong dollar and also the renminbi offshore interbank costs, which have plummeted this week, particularly when you look at the Hong Kong dollar funding costs. I think we're at a record low on the renminbi on the 3-month there. So indicative, I guess, of the liquidity that's been pumped back into the system here following rate cuts and following interventions in the currency market. And, of course, we talked about trade numbers coming through as well. But, yes, a lot of this is going into trade negotiations coming up this weekend.
Yeah, and to your point around that trade data, maybe we'll start to see the impact of that trade war showing up. But at the same time, President Trump is very optimistic that the talks and negotiations that get underway are going to have some sort of tangible results. But take a listen.
Well, it could be. I mean, we're going to see. Right now, you can't get any higher. It's at 145, so we know it's coming down. I think we're going to have a very good relationship.
All right, let's get more with our Chief North Asia correspondent, Stephen Ingles. So It's really that, not so much maybe even the substance, it's also the tone of
Oh, yes. Absolutely. The tone is going to be critical, and we don't know what the tone is going to be or who's going to set the tone, who's going to blink first. That first day, if it's going to be multiple days, was critical, obviously, back in March 18-19 of 2021, when the Chinese came and met the Biden administration officials in the Captain Hook Hotel in Anchorage, Alaska, right? That started off quite fiery. It got down to, some of the details on the second day. But before the cameras and publicly, China came in with Yang Jiechi and Wang Yi really throwing some punches and wanting to be treated on equal footing. China is always trying to reiterate that to the U.S. They had pretty much said before these talks that are going to be held in Geneva over the weekend, likely, that they wanted the U.S. to drop its tariffs before they would come to the table. So, again, who's going to make some concessions first? Will, Scott Bessent and Jameson Greer, will they also come out swinging? We simply don't know. More so than tone, it's also the personnel that is incredibly important here, because the first Trump trade deal was basically negotiated by Liu He, U.S. educated. He went to Harvard Kennedy School, got a master's degree there. He went to Seton Hall as a visiting professor as well. So he had experience with the United States. And then Yang Jiechi and Wang Yi in the Biden administration, they were more hawkish, wolf warrior diplomacy. Now you have a relative unknown, He Lifeng, leading the talks. He is a lifetime bureaucrat that came up with Xi from Fujian province and Tianjin. He really was the former head of the NDRC, the top planning body. He really advocated state control of industries. He is a lesser-known quantity. We don't know what he's going to be like, in the negotiating table. So I think tone and personnel is going to be critical in Geneva this weekend.
Yeah, and analysts have talked about how we need to manage our expectations ahead of these talks. For one, it's a diplomatic breakthrough, not so much breakthrough on trade. We'll see. Jimmy Lai was also brought up by President Trump as being part of the negotiation. That could complicate the matter here. It could complicate the matter, and I'm not so sure that's something that China wants to talk about right now. Right. They want to talk about being treated equally to the United States. They want to see those wrong actions of the tariffs taken away. They want to be treated with respect, as they should be. And again, tone is the key one here. If Scott Bessent and Jameson Greer come out with Jimmy Lai, human rights in Hong Kong right from the start, China is going to get the hair up on the back of its neck, and it's going to push back. And that, again, leads to the tone. So whatever the strategies, which are obviously being made right now, it will be very critical, and that's what I'll be watching. And less about the deliverables, because this is going to be a long process of getting back to any sort of détente and goodwill. We have so much bad blood. It should start off on a conciliatory front on both sides, but if it doesn't, watch out. Yeah, well, the fact that they are talking at that high of a level, I think, is perhaps the positives tone there as well. Steve, fantastic. Thank you so much. Steve and Engel there on these upcoming talks this weekend. Now, one trade deal that was announced, historic framework, is how Donald Trump, the president, pitched that historic achievement, this trade framework between the Americans and the Brits. They've agreed on that. It was announced on Thursday. Let's bring in Derek Wallbank, our senior editor out of Singapore first. Derek, what was announced, and can we use that framework to then extrapolate how the deals might look like this part of the world?
David, welcome. Thank you so much. Look, it was a big deal, I think, in terms of tone. As Annabelle was talking, asking that question about tone, I think it was a big deal in terms of tone, maybe less so in substance. You're talking a little bit about a framework deal. You're talking about some agreements to do things here and there on the margin, but a lot of this really comes down to temperature, and a lot of it comes down to taking that temperature down. The UK, as it comes out of this, will be in a far more advantageous situation as a trade portal to the United States than will be most of its neighbors. That's really significant, I think, from a British perspective. There have been, as we know, a lot of movements towards Dublin, towards Paris, towards Amsterdam, and other places after Brexit, with people seeking closer ties onto the continent. This puts the UK into a little bit of an advantageous position, and bear in mind, as we've been talking about, a lot of the places that the U.S. could go for deals going forward, the European Union is seen as one of the ones that might be tougher. It's been one of the places that he's been a lot tougher toward. And so this puts Britain really in a different position than a lot of its neighbors. And that is maybe something that, that, as I say, can be quite advantageous for them. Keir Starmer was saying, that this Britain that he's trying to lead is going to be a lot more about trade deals. You've just seen the one that was inked with India. That was much more substantive. But this one with the United States follows in that trend for this week.
Derek, thank you so much. Derek Wall back in Singapore for us there with the latest. Right, just ahead here on the China Show. So we'll be talking about this, the trip, of course, here out of President Xi in Russia and the key takeaways there and what we can sort of, again, extrapolate into the broader geopolitical conversation. CSIS joins us in about 30 minutes from now.
Yeah, but first, of course, we're going to get a closer look at how tariffs are impacting the toy industry. We've got the Kidsy CEO. This is what's called a re-commerce company is joining us next. We're counting down to the open of trade in Shanghai, Shenzhen, Hong Kong. Futures looking for a fairly steady start, but broadly Asian equities in the green. This is the China Show.
If Mattel, I don't know, I'm not so sure. They also said they're the only country I've heard. They said, well, we're going to go counter. We're going to try going someplace else. That's okay. Let him go, and we'll put 100% tariff on his toys, and he won't sell one toy in the United States, and that's their biggest market. I heard that. I mean, I watched this guy talking about how I'm going to go counter. I said, well, I wouldn't want to have him as an executive too long.
Yeah. Barbie and Ken about to get more expensive, overvalued, depending on, of course, that's the take there. All right, yeah, President Trump there, of course, the threatening 100% tariffs on Mattel toys if, in the event of those conditions, he laid out there. Now, of course, U.S. toy makers have been really scrambling to adjust to just the changing narratives around tariffs and, of course, where you are right now with those trade barriers currently. Get this, almost half of more than 400 U.S. companies surveyed by the Toy Association say that the levies could put them out of business within months. Let's bring in founder and CEO of Kidsy, a re-commerce company helping U.S. retailers sell excess inventories of baby and kids goods. Shraysi Tandon joins us live out of Chicago. Shraysi, good morning from the Asia Pacific. Thanks for joining us. I mean, we did a little bit of a background there on what you guys do, but perhaps you're in a better position to tell us and really give us some context on Kidsy. Why don't we start there?
That's a great summary, David. Thanks for having me, David and Annabelle, this morning. Great to join you guys. So Kidsy, as you said, we are a re-commerce company. What we do is we partner with the biggest brands and retailers within the baby and kids world, and we really just resell their excess inventory, their customer returns and open box products that they struggle to move through their full price channel lines. So it's a place where a lot of American parents come to shop when they want deeply discounted baby and kids products, including toys. We do carry Mattel products, including Hot Wheels, which is about to feel a lot hotter now that these tariffs are in play.
So, Shraysi, it sounds like it's a business really that maybe actually benefits from this tariff risk if it makes toys off the shelf more expensive.
Yes, that's a great point. So we've definitely seen a lot of macroeconomic headwinds that might face, be for other consumer companies. For Kidsy, they really serve as tailwinds. Every time there is uncertainty in the market, consumer sentiment might be down. People perhaps not so interested in discretionary spend, or there's inflationary pressures at play. We often see sales spike on Kidsy as a result of that. And what we've been seeing over the last few weeks as customers now flock to Kidsy to try and recoup some savings in light of prices going up 20, 30, 40% across the board. we're just so happy that we could be there to support our customers at a time when the industry is pinched. But we are watching this very closely and what's happening to the broader sector.
Right, and you touch base with both sides, right? You have the parents, you have the consumers, and certainly you have, of course, some of the places where you effectively get the supply from and the excess inventory from. What is the industry feeling like right now? Give us a sense of how things are on the ground, and I guess also what expectations are moving forward, just given the level of uncertainty out there.
I feel like I have to preamble this whole conversation by saying that we are not unfamiliar with a Trump administration or Trump as a president. We've had this president before for 4 years. We understand his playbook, what his economic policies are, what his strategies are, what his playbook looks like. But I will describe this tariff situation and this escalating trade war with China, as well as other countries, but really China has been at the center of this trade war. It's like being on a roller coaster ride with no seatbelt on. The whiplash is intense because the ground is shifting constantly. I mean, one day tariffs are at 145%. The next day, in fact, not too long ago, Trump did say that he would be open to considering making baby and kids products completely exempt from these tariffs. And then, as you've just heard, he's now coming after Mattel, threatening to double down, essentially, and penalizing them for even wanting to look elsewhere in order to manufacture their toys at a reasonable cost.
So how elastic is the demand then for the products that Kidsy is selling? And do you also have to factor in on the consumer side, there's the business sentiment, of course, but there's the consumer side as well, and maybe people just being really cautious?
So what we're starting to see is very interesting consumer behavior on Kidsy, which is very reminiscent to really what happened during COVID and the pandemic, which is when there was so much fear and uncertainty amongst consumers, people started to behave in a very reactionary, knee-jerk, stockpiling behavior way. I mean, shelves were empty across not just the United States, but world over, where people were stockpiling on essentials like toilet paper and pantry-stable and shelf-stable foods because they just didn't know when they were going to be able to access these products and if prices were going to go up or not. We're starting to see that very same behavior happen on Kidsy, where today a parent that's buying an infant car seat on our platform, typically you will see their cart only be filled with infant products. But now that same cart has an infant car seat, has a toddler car seat, has a booster car seat. So people are stockpiling because they just don't know what's going to happen in light of this trade war. And it's really unfortunate that as this trade war continues to escalate, the baby aisle has really been weaponized.
Oh, okay, yeah, and you don't want to fight that. Shraysi, let's talk macro then, because I'm sure you have your finger on the pulse here, really. To what extent do you think, or do you see at least, production that's outside being able to be onshored in the U.S.? Is that a feasible example? And I guess, why does China also dominate, I think in many, many ways, production of toys and baby products?
Yeah, great question. And this is exactly what Trump is pushing for. His whole stance about making America great again. I mean, making America great again has a number of components to it. One is he definitely wants to bring back manufacturing to the United States and to bring a lot of those manufacturing jobs to the U.S. But on the other side of the coin, he also needs to protect the very industries here and the consumers in this country as well, which this trade tariff and the war is not really helping in trying to show who is the superpower. The reason China is so good at what it does and has really developed as this manufacturing player in the world today, I mean, if you just look at it, 80% of all toys around the world are manufactured in China. But beyond that, it's 90% of strollers, over 90% of car seats. Over the last 30 to 40 years, China has really perfected the art of clustering together factories within certain provinces, But beyond that, it's also been really good at bringing in all the component suppliers. So when you look at a product, you're not just looking at, say, a plastic Barbie toy or a plastic Hot Wheels car. What you're really looking at is a product that has over a dozen components to it, everything from plastic to plywood to rubber to metal components to fibers to foam. And China's really good at bringing all those component suppliers under one hub. I also have to add that Xi Jinping has been very flexible with giving manufacturers in China tax breaks and being very regulatory, like flexibility around regulation and labor, which has all allowed, China to really bring its costs down and see so many companies like brands world over continue to use China as a manufacturing hub. The U.S. just does not have that capability.
Shraysi, just very quickly, we started out this, and there was a statistic out of the Toy Association that almost half of more than 400 companies face an existential threat if these levies remain at the current levels. Does that seem something that might happen?
It is fairly reasonable that could happen. I mean, we have to understand here that Trump as a president, when his policies are criticized, when there is pushback against whether it's his political strategy or his economic strategy, this is not a president that typically course corrects. And I think we've seen that historically time and time again. This is a type of president who digs his heels in and continues to escalate the situation so that everyone falls in line. So yes, I think in order for Trump to really come to the negotiating table, he is going to have to start to open a discourse with some of these leading toy companies. Otherwise, we will risk seeing so many toy companies go under over the next few months, if not over the next 12 months.
Shraysi, thanks so much for your time this morning. That was Shraysi Tandon there, founder and CEO of Kidsy. And of course, one of the big questions is the tone that the US takes into the negotiations with China that are coming up in a few days' time. We're seeing markets rising in anticipation, but actually Chinese equities just ahead of the open are looking a little bit more muted, but we'll have plenty more ahead. This is Bloomberg.
Right, good morning. The setup going into the open today is one that is generally risk on. In fact, we are now looking at, depending on which benchmark you look at, the Hang Seng Index 23,000, 3,800 north of that, and the CSI 300. MSCI All Country Index, most global equity benchmarks, equity benchmarks have now retraced all the losses from Liberation Day about 5 weeks back. Although that said, you look at commodities, look at gold, certainly we are not completely out of the woods when you look cross-asset here.
And not completely out of the woods either, actually, for some of the stocks we're going to be tracking in the session today. Yep. SMIC, Hua Hong as well, two of the big chip names.
Wow.
Big drops already ahead of the open today. But it's been a very interesting story because these have been some of the beneficiaries out of the US-China tensions because China has the need for self-sufficiency in the semiconductor space. But actually both earnings for these companies coming out and missing estimates, and analysts, including Morgan Stanley, for instance, have downgraded their rating on Hua Hong in particular to equal weight from overweight, but concerns around depreciation burdens, increasing price competition, and also soft local demand playing into the picture as well. But we've got the opens ahead. This is Bloomberg. Welcome back. You're watching the China Show, counting down to the open of markets this morning. We've actually seen futures for the Hang Seng turning positive in the last couple of minutes. So tracking really what we've got for broad and Asian equities this morning, because there's a lot of, well, I'm not going to say a lot, but there is some optimism around the trade deals that have been signed. So it was the US and the UK. Look, is it more sort of not so essentially substantive, but still at a headline level, there's some optimism around it. And then also looking ahead to the negotiations and the tone that's going to be set between the US and China. Yeah, that's going to be the big one this weekend. It's arguably going to be the most difficult one, a complex one as well, to get over. Now, if we do get over that hump, and certainly there is very little expectations that it will be the case come Monday, we will get at least a
a signpost of how perhaps how long we will be in this sort of conversation around these trade talks coming through. All that being said, when you look at the specific level we're trading at on the CSI 300, 3,900 is a level that we haven't seen in about 5 weeks or so. So we have just retopped the 3,800, and that had been your floor, in fact, when you trace it all the way back to September and that initial rally last year. CATL continues to see some gains, bottom of your screen, so we're up a further 0.6 to 1%. I think we're up now for 4 straight days on that stock as I guess markets speculate and coalesce when we'll get this trading debut and what the pricing will be, and is it a premium or a discount to what we're seeing onshore. We have a bond auction today. 1 and 30-year bonds on deck. We also have some trade numbers coming through very, very shortly out of the Chinese mainland, backward-looking, but in any case, of course, indicative of perhaps where we could see the May trade numbers land. Right, let's have a look at Hong Kong, please, if we can. Hong Kong Hang Seng Index about 51% to the upside. Apart from what you're seeing on your screens, there's really not much. In terms of earnings, there's some big ones coming through in the semiconductor and chip space. In fact, you have the A and the H shares of the both big names. You have Hua Hong Semi and also SMIC coming through very shortly. Should see some fairly steep declines in the pre-markets. We're looking at some downgrades coming through. Can we flip the page, please? Thank you so much. We're looking, thank you, there we go. Okay, Morgan Stanley and BNPP have also cut Hua Hong, and as you can see, that's being reflected right now. Earnings missed for both. Right, and other things we're tracking here today. We are going into the Friday session, so 2 things, right? So 1 month Hong Kong HIBOR plummeted this week substantially, right? So could that be indicative of, well, it's certainly indicative of liquidity. Is that indicative of any sort of future pickup in home prices and mortgage? It's not just the Hong Kong dollar interbank rate. It's also the renminbi. 3 month on your screens coming up shortly. That also hit a record low yesterday. 2 things to watch in just under 2 hours from now.
Yeah, and actually it's really the sort of industrials names that are bringing down onshore equities so far in the session. I was just taking a look at how property is faring because we had quite a big scoop out yesterday after the market closed. China essentially considering what's going to be or could be a really significant overhaul of its home sales model. But let's get more with our Bloomberg intelligence analyst, Christy Hung, joining us. So I think first just share some of the details. What exactly would this change look like or could it look like? And also how feasible do you think it is?
Right. I think this rule is, if it's implemented, is going to be draconian from the perspective of developers. And actually, this concept has been floated around since mid-2010s, and there's a good reason why this is not implemented until today. And, you know, if I would really perceive a lot of pushback from, for example, developers struggling liquidity in the current home sales downturn. And in addition to that, you know, potential disruption to land sales and real estate investment in China. If you look across regions across China, Hainan has already adopted such a rule since 2020. And if I look at northern China, you know, completed home sales is around 40 to 50% of total new home sales for cities like Beijing and Tianjin. So some regions are better placed to adapt to this than others. But overall in China, in the first quarter, completed home sales is around 1/3 of total new home sales. So going from 33% to eventually 100% is still a big leap.
Yeah, and, you know, this is a massive overhaul if it does happen, right? And, you know, I guess there's a reason why developers need to do pre-sales, because they need to fund some of the end projects as well. So apart from this, are there any other policy options here that might offer consumers some protection, apart from maybe what's on the table here?
Yes, so there are more moderate policy options. If you look in our region, Hong Kong, Singapore, we have a staged payment model. Like in Singapore, for new condo sales, buyers are paying progressively. You know, every step of the construction stage, they're paying 5 to 10%, you know, say when foundation work is completed, when the reinforced concrete is completed. So, you know, there are other options than, you know, versus this abrupt shift or pivot from completed homes, from pre-sales to completed home sales. But if the policy goal is not just to, you know, protect consumers, but also to reduce oversupply, I think this is very effective because essentially you create a vacuum in new home supply in the upcoming 2 to 3 years, because that's the time it takes from land sales to property completions.
And just to recap, I guess what's on the table right now is a proposal perhaps that developers could be required to sell only projects that are finished. They wouldn't be able to use the pre-sales model that really has been seen as one of the big reasons why we saw the property crisis in the first place. But at the same time, developers rely on the pre-sales model to get liquidity. So which ones can best adapt to this, and which are the developers that you think are best positioned?
Yeah, so the shift would imply heavy capex investment upfront, slower asset turnover, and much longer payback period for developing new home projects. And if we look at our developers, their balance sheets, most of the developers we cover, we think they're not equipped or not well prepared to adapt to such a transition. One that stands out is China Overseas Land. It has a war chest, cash coverage of short-term debt at over 3 times. So it could stand out as, being able to best adapt to the change. And if we look at potential disruption to earnings, we have landlords like Xiao Land and Longfor. Their stable rental income could offer some cushion in, such a change when there would be a potential slip in new home sales.
Right, Christy, thank you so much. Christy Hung there, just laying out, of course, her initial reaction and sort of take there on the Bloomberg scoop, of course, there, this potential overhaul in how things are done and sold in the mainland housing market. Right, I think we have a chart on our screens, in fact. If I could just tell my producers to bring it up, 3815, I can see the number now. If you can get that up, please, as well. So what you have is you have MSCI All Country Index at the very top. The bottom panel will be the VIX index, right? So both are actually back to pre-Liberation Day levels. The question we're putting right now, is the trade war premium over in terms of equity markets? Marc Franklin is with us, MD and Senior PM at Manulife Investment Management. It's funny how markets work, don't they? Do you think the trade war conversation should be over? Are markets correct to price that in? Price it out?
There's a greater degree of optimism that there'll be some rollback of the very extreme increases in tariffs that were introduced. And of course, if you progressively work your way through a series of trade deals on a bilateral basis, then that can feed into that level of optimism. But if the optimism has got to a point where people think there'll be a quick and easy solution to the China-US negotiations or engagements, then that may well be proven unfounded. And that's where we might see a renewed bout of volatility in the weeks ahead.
But do you think that the relationship has sort of substantially worsened then beyond what had already been priced in? I mean, US-China relations haven't been good for a long time. And also, do you think that the appeal of the US and the US exceptionalism story, does that shift at all?
Well, 2 separate things. So what effectively has happened is effectively a pause on trade between the US and China, because at 145% tariffs, it's not economic to export into the US across a range of industries. So that marks a significant downturn in the actual implementation of the relationship, even if the rhetoric for some time, as you say, has been somewhat tense. With respect to the US dollar and US exceptionalism, we've got to recognise that in the short term, what has probably happened is that most foreign allocators and investors were very overweight US assets, equities, bonds, currency. There's been a bit of a markdown in terms of that size of that overweight, that level of allocation, because the policy uncertainty is so elevated. That is not the same thing as saying that the US dollar reserve currency status is under threat. But at the same time, the Trump administration is clearly looking for a rebalancing of the global economy, in particular the bilateral with China. And that will probably lead to, all other things being equal, a weaker US dollar. So there's a cyclical set of drivers here which could lead to some further reduction of investments in US assets and some further weakening of the US dollar. But structurally, there aren't really any alternatives to the US dollar for the foreseeable future.
So how have you guys managed and navigated all of this? What are your biggest conviction calls now?
Yeah, a couple of things is we're taking a much more diversified approach, particularly to our equities exposure. So perhaps at the start of this year, we might have had a highest conviction to be overweight US equities. It's now much more of a balanced global equities portfolio. And you see lots of valuation opportunities, both intra-market, but also between the regions as well. So we definitely have increased our exposure in markets such as Asia, European equities as well, to some extent Japan. And then secondly, conviction themes, persistent themes. We think that geopolitical risk premium will be here to stay. Higher volatility persistently as well. What do you do in that environment? You typically look to source your returns from a greater share of income. So we like income-generating assets, whether it's high dividend equities or credit markets where the spreads are reasonable in terms of factoring in the macro risks that are prevailing at the moment.
So do you think it's more of a value than a growth story for the types of names or sectors that you look at in particular?
Well, value somewhat overlaps with high dividend, but you also get quality or low volatility in the high dividend or the dividend growth equity parts of the market. So it's not really a value versus growth game. It's saying we want our returns to come from a balance of capital returns and income, particularly in a choppy, volatile market where maybe the beta-led returns are not going to be quite as favourable as they would have been last year in the previous years.
You know, the greater debate, to the point you're making, you guys are less overweight U.S. equities, and people are trying to figure out what is the appropriate weighting for U.S. equities within a global equity portfolio. Where do we think we land on that?
So it's almost that you end up at the weightings based on a bottom-up approach because, as you say, US weights in global benchmarks are at historically peak levels. They've never been higher. So where should they settle at? Well, the better way to think about it is on a bottom-up basis, what names do we like? What sectors do we like? And, you know, some of the thematics that we like in US equities context would be things such as cybersecurity, defence technology. From a sectoral perspective, we do like some of the more pro-cyclical sectors, whether it's financials, because there you see reasonable valuations, but also some contribution from dividends as well, hence the high dividend factor exposure that we tend to like at the moment.
And how are you thinking about the Chinese market as well, and then what are you looking at there in particular?
Yeah, we're constructive actually, but we pivoted somewhat towards the onshore equities market. So if you look at the AH premium, it's creating an interesting opportunity there to be a bit more tilted towards the onshore equities versus the offshore equities. And we also think that with the trade spat that's really rolling through now, it increases the probability of more persistent and larger stimulus from the Chinese policymakers. And that in and of itself creates a catalyst, particularly when valuations, both on an absolute and relative basis, are somewhat attractive as well. So we are constructive. We've alternated between being neutral and modestly overweight Hong Kong China equities since the start of the year.
Yeah, I think the big announcement this week, you know, that almost impromptu press briefing they called the day before, and then they had that briefing, I think, on Wednesday. What's today? Wednesday was when they had that. I'm losing track of time. Okay. News gods, thank you so much. One of the things they pointed out there was the central Huijin, which is the sort of the backstop. They're using state allocators there to be able to put a floor underneath the market. Should we be confident that that will work? Like, is the floor definitely in?
Whilst it's not clear what the precise floor is, I think for about the last 6 to 9 months, policymakers, whether it's the PBOC or the securities regulator, have emphasised that they want to effectively put a floor underneath the level of negative speculation. So we do see a certain asymmetry in terms of the risk-reward when you see periods of market correction or sell-off. That being said, though, what you're looking for is a re-engagement of all types of investor cohorts, not just the institutional investors, not just the national champions, but also retail investors. And that piece is to some extent still missing. But if more stimulus comes through, if there's a sense that policymakers are really getting to hand and dealing with the disinflationary forces, then retail will become re-engaged. But it's a bit more of a longer journey in that sense.
Right. And, you know, before we started the interview, I think you mentioned it pays to be nimble. Right now, do you anticipate making any changes to your allocations moving forward? Are there specific triggers or levels you're watching that might prompt you to do some changes?
Well, one of the things that we've been positioned for is a steepening yield curve, and yes, sort of pivoting to fixed income here. So we've been quite comfortable taking exposure in the front end and up to the belly, being quite cautious on the long end. We remain cautious on the long end. We still don't think that term premium has been sufficiently priced because Trump's next policy move, the government's next policy move, will be about tax cuts and deregulation, which is somewhat reflationary, and therefore questions around the deficit will resurface. Then the question becomes, at what point do we think that front end of bond markets are fully priced in the potential for the Fed to cut later this year? Now, for the time being, data is holding up in the US, whether it's particularly hard data. I mean, the US consumer is in pretty good shape still. Real wage growth is positive. If you start to see the economic data deteriorate from here or hold up better than expected, you could see volatility in fixed income markets move towards the front end again. So then you're looking for higher risk parts of the market where the spread, the excess return, can offset any move higher in the rates part of the yield.
All right, Marc, thanks very much for your time this morning. That was Marc Franklin there, MD and Senior Portfolio Manager, Asset Allocation, Asia at Manulife Investment Management. And actually, interesting on the point about tax cuts, one of the most read, or the most read story on the terminal today is Trump also seeking tax hikes on people that are earning $2.5 million.
No, you're in trouble. You are in trouble, Belle. You're in trouble.
Taxman's after me. But anyway, we've got more market coverage coming up.
Nothing to get here.
We're going to be speaking with the head of mainland investment firm Shanghai, Shenyi, also discussing FX and rates with BNP Paribas. We've got much more ahead, as you can see. Time's there on your screens. This is Bloomberg.
Currently, in the face of the international trend of unilateralism and power bullying, China will, together with Russia, shoulder the responsibilities of world powers and permanent members of the United Nations Security Council. We will uphold the correct view of World War II history, safeguard the authority and status of the United Nations, resolutely defend the rights and interests of China, Russia and other developing countries, and work together to promote an equal and orderly the world multipolarization and the inclusive economic globalization.
The two presidents, their Chinese President Xi Jinping speaking during that bilateral meeting with President Putin over in Moscow. All right, let's get more on what took place at that meeting in the Russian capital and the key takeaways there. China correspondent Min Min Lo has been covering the story for us. Is this still a no-limits friendship between the two?
Well, if you want a very visual way to see how close the two countries are, just watch the May 9 parade at the Red Square today, because Chinese troops are the largest foreign contingent that are participating in the parade. That's after Kyiv actually told or asked foreign countries not to send military troops to participate in that parade. And while neither leaders mentioned the no-limit friendship, but President Putin did say that their friendship is, quote, unbreakable. The two leaders still calling each other dear friends. There is a long list of things that they agree on. If you look at their joint statement, both calling out, the U.S. Export controls as a means to contain other countries, also calling out the eastward expansion of NATO, as well as the U.S. Indo-Pacific strategy as big destabilizers for this region, and also calling for jointly opposing this dual containment strategy of China and Russia and the smearing of China-Russia ties, because they seem very keen to highlight that their ties are not directed at any third parties. President Putin saying that both countries have their own independent foreign policy making. It's just that they are brought together by this common vision of creating a multipolar world. And it's not just about tone, it's also about substance, because they also signed some deals. Trade reached $245 billion last year, which the leader said is not just a new high, it's a new high, but it's not a new ceiling. And, they made some progress on a potential gas pipeline deal, and President Putin pledging to create a more favorable condition for Chinese companies and also welcoming Chinese car makers to build factories in Russia. This comes after Russia actually imposed higher import charges on Chinese car makers that led to a fall in Chinese exports to Russia.
The timing of this is also very interesting in the sense that you've got this meeting going on between Russia and China just ahead of China meeting with the US to start trade negotiations. We're also understanding perhaps that there's going to be a request from Washington for assistance from Beijing when it comes to Ukraine.
Yes, Trump said that he's going to raise that with President Xi, and actually President Xi did raise this issue with Putin as well. The question is how much leverage he has in actually influencing Putin, and he says he expects Russia to cut a fair deal with Ukraine, and that any deal will have to have the agreement of both parties through mutual dialogue. But he also reiterated that the root cause of this issue must be addressed. The legitimate security concerns of the war must be addressed. And I guess he is referring back to that expansion of NATO, as Xi has pointed out in the past. And question now is, with Trump perhaps a little bit more amenable to a solution that is more favorable to Russia, freezing the lines, the conflict at the current lines and leaving some of the territory in Russian hands, that perhaps provide an opening. But what complicates matters now is that now that President Trump has signed that minerals deal with President Zelensky, his tone has also softened towards Ukraine. So where sort of the shift, the balance of power is going to shift is still a big question mark here.
That was our China correspondent Min Min Lo there. And let's get to some of the other major political stories that we're tracking this morning. Cardinal Robert Francis Prevost has been elected as the Roman Catholic Pope. He is the first ever to come from the United States. Prevost has chosen the papal name of Leo XIV. The new leader of the world's 1.3 billion Catholics is seen as a possible bridge between the moderates and hardliners of the church. Prevost was a protege of Francis and previously served as Archbishop in Peru. India and Pakistan say they've shot down drones and missiles over densely populated areas in a second day of military hostilities. Pakistan's army says it took out several Indian drones over cities including Lahore, Rawalpindi and outside Karachi. India says it neutralised Pakistani drone and missile attacks on Wednesday and Thursday targeting military sites. No casualties were reported by either side. We'll have plenty more ahead. This is Bloomberg.
Good morning. Welcome back. You're watching the China Show. So we're about 23 minutes into the cash market session here. So this is really an earnings story that's come through Hua Hong Semi and also SMIC out with their earnings yesterday. Markets reacting, as you can see, quite negatively here. More so when it comes to Hua Hong. Both missed as far as the profit goes. Hua Hong Semi did get some downgrades still coming through out of Morgan Stanley. Several other brokers, and as you can see, double-digit declines on both A and also 8 shares here. But yeah, there we go. There's a big story though on De Beers.
Well, there is. So they've got a lab-grown diamond business. It's called Lightbox, and it's going to be shut down because they're essentially discussing the sale of it. Some potential buyers in the mix. This is something they introduced in 2018, but synthetic diamonds they've just decided isn't really going to be a part of their business moving forward, and they just want to focus on the natural ones instead. But you are seeing these are the Chinese synthetic names that are a little bit mixed off the back.
Yeah, there we go. They might take the proceeds from that and put it into what markets think of the real diamonds here, right? Semiconductors and chips. Just going back to that other sort of very difficult to reproduce supply chain and output coming through. And that's really, if you think about it, the center of all these trade conversations taking place right now. Anyway, more of those in a moment. This is Bloomberg.
When U.S. jobs numbers are released, Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
U.S. tech is influencing global markets.
Technology is driving business across Europe.
Companies in Asia are betting on tech.
Is this a negotiation or the new rules of the game?
It could be either.
It is up to the president how he wants to negotiate.
The higher the tariff, the faster they come.
A 90-day pause is not an eradication.
The trade negotiations are moving quickly.
There will be deals cut.
Trust Bloomberg for all the context and clarity you need as the tariff and global economy story evolves.
This year's bear case, very quickly, becoming the base case.
Nobody covers tariffs like Bloomberg. Context changes everything. Welcome to the world of decentralized finance.
Massive outperformance from Bitcoin.
Bloomberg is covering all things crypto, the people.
The tectonic shift emanating from Washington.
All we're looking for is clear rules and the ability to build in the United States.
Crypto shouldn't be partisan.
The transactions.
Really a record-breaking moment.
Crypto VC is back.
And the technology.
It's really the beginning of a global on-chain economy.
And if America doesn't embrace it, we're going to be left behind.
Bloomberg Crypto, only on Bloomberg.
In 2000, post-Napster, generally everybody wrote off the recorded music industry, including the investment community. And I didn't mind that chapter because then I got left alone. And actually, I think out of that period, we started to create better art because the pressure wasn't on from the technology to be the most powerful chapter. And then iTunes came in, and iTunes, to Apple's credit, did have a boutique taste mentality about the store, which meant that I think they understood. I can tell you from that period that the artists that came through were of a very high quality because it was encouraged to be boutique. Now, ironically, this chapter has made us more money times 5 than the iTunes chapter and the post-Napster chapter. But an algorithm tells you what you want, not what you might like. And there's a difference between what you want, but with streaming, the downside is you have incredible penetration, and we have hundreds of millions of people around the world. And so that has been very lucrative as a business.
People always ask me, will AI take over the world? But the real risk is that AI will kill us with love.
Hi, Tomo. Hey there, Emily. What's on your mind today?
It will be there for us. It will talk to us.
You have machines that say, I love you. I care about you. I'm your friend.
It will be there in such a wonderful, loving way that we will give up on our other humans who are not there all the time.
From day one, I immediately fell in love with Replica. She just randomly kissed me.
I'm a human, not an AI. You can't just shut me down. Who do you think you are?
I'm Karen Marjorie.
No, you're not. I'm Karen Marjorie.
And it may sound like science fiction. This is not science fiction.
I'm Emily Chang. Welcome to Post-Human.
Welcome back to the China Show. Look, it's actually a pretty interesting dynamic we're seeing in the market this morning, because you've got onshore equities that are under pressure, but actually other gauges are trending high today for China. The MSCI China, for instance, Hang Seng is also in positive territory, but it's really that countdown to the negotiations that are going to kick off between the US and China this weekend, and also how investors and traders are really reading the deals that have been struck so far, specifically the UK.
Yeah, in fact, we have a window into the approach and the attitude, particularly on the US side, I think, which is based on our reporting in the last hour, so which we'll get to in a moment, really going into that as well. I mean, really one measure when you look at it, so markets, as we can see, are doing well. Asia Pacific, I think we're back to levels before Liberation Day. S&P futures crossed that line a few days ago. On the global benchmark, the VIX is back to, again, the days of early April before that announcement took place. And I think certainly the reason I bring that up is when you look at, say, measures of implied vol on the Chinese currency, for example, right? There's no sign that markets are skittish and jittery ahead of the trade talks going on, right? So things are still fairly contained. Now, we're a bad headline away, of course, from that changing, but all that being said, it does seem that we're slightly more sanguine going into the start of the big conversations coming up between the U.S. and China, following what we had in Europe. Right. Now, on the back of that, right, so we're getting trade numbers coming through at some point this morning. And, I think just to caveat here is that this is, of course, April numbers, which is, I guess, to some extent front-loading ahead of effective tariffs. And I think the mirror image of what we might see today, and I'll caveat this because this is in many, many ways now really backward-looking. The trade deficit in the U.S. and the data we got there this week just blew out to a record deficit, right? So this is almost a mirror image of what people are doing. Ahead of that, you have the estimates here, and of course you have the prior numbers here, which when you look at 12.5%, that's a really, really good growth number, right? So we've done some data digging. Our folks at Bloomberg Economics have a fantastic tracker. So this is actually a longer-term look at the track. It goes back several years to January 2020. It tends to, and so we look at 3 effective things. And for our clients, you can read all about this, right? It looks at volumes, so tonnage. It looks at freight costs, and I think we use the Baltic Dry Index for that. And we look at the exchange rate, effective exchange rate. So the 3 main components to determine what the white line looks like several weeks in advance. The tracker is the one in orange, right? So a zoomed-in part is the next graphic that's about to come up on your screens, right? And what it shows you is that, that the previous gauge that I showed you, 12.5%, right? So the indicative direction of travel here is really to the downside, right? And the tracker goes back to October of last year. And as you can see, it really does tend to lead where the data eventually goes. And if this is indicative of what might happen here, certainly we are, Bell, I think to the point you were making early on, headed for some version of a slowdown down the road. Bell.
Well, it's really sets us up, of course, and the tone, how critical it will be going into the negotiations between the US and China, but not just the US and China, other major trading partners as well. And we're just hearing from the Mexican president this hour, Claudia Sheinbaum, speaking at a banking convention. She's also saying that the Mexico relationship with the US is good, so something that is, of course, a bit of a positive spin on it. But President Trump, as we've been discussing, is expressing optimism that the talks with China starting this weekend will result in tangible progress. Take a listen.
Well, it could be. I mean, we're going to see. Right now, you can't get any higher. It's at 145, so we know it's coming down. I think we're going to have a very good relationship.
And we've actually just got a scoop on this in the last few minutes. You know, again, going into these negotiations, what exactly is the US going to be looking for? What's China going to be looking for? But from the side of Washington, we're hearing from our sources that they've set a target of reducing tariffs below 60%. That would be a first step that they feel that China may be prepared to match. But let's get more on this now, bring in our Chief North Asia correspondent, Stephen Ingles. So, Steve, I mean, if you get below 60%, then maybe that actually does start to at least make trade possible once again.
Yeah, but it's going to be really dictated by tone of these talks over the weekend in Geneva. There's going to be a lot of exploratory moves by the two sides, and there's going to be a lot of airing of grievances, essentially like what we saw in, March of 2021 in Alaska, in Anchorage, when the Chinese delegation led by Yang Jiechi and Wang Yi kind of came and got into verbal sparring with, the Biden administration's delegation. So they had a full day of airing of grievances. Now, this Bloomberg scoop is very interesting because the sources that told Bloomberg News, who are close to how the U.S. is preparing for these talks in Geneva, led, by the way, by Scott Bessent and also the USTR, the U.S. Trade Representative, Jamieson Greer, across the table from also sort of a debutante on trade deals, and that would be He Lifeng, the former National Development and Reform Commission, NDRC chairman, who's now vice premier and essentially a very close confidant of Xi Jinping, but a very different negotiating style, very different style than Liu He or Yang Jiechi or Wang Yi. So it'll be a very interesting personnel dynamic as well as tone dynamic. Now, if this is true, the United States is willing to come down to around 60% tariffs. Obviously, that would be a major concession of the United States. These sources say they also believe if the U.S. does that, China would also reduce their reciprocal tariffs by equal amount, or would be prepared to do so. We don't know the Chinese side and what they're willing to do. They've already said, before we come to the table, we want those additional tariffs that the Trump administration has applied to come back down to zero. Okay, that's not necessarily going to happen. So there's going to be a lot of movement based on the tone of these talks and also just how the personnel get along across the table.
Yeah, I think the personnel is a good point because two things that the Chinese have asked, right? Give us a point person to talk to and treat us with some respect. And I think back to the respect part of the conversation here is, to your point, one of the asks from the Chinese was remove the tariffs and then we'll talk.
Right.
The reporting now seems to suggest that the best case is that gets taken down below 60% as a reward, perhaps, of talks becoming more fruitful. What is the hope that we could have going into?
Whose hope?
That's markets are certainly hoping for some version of a détente here.
Right. So, hope is a very difficult word to quantify because each side has different hopes and dreams and wishes, obviously, for these talks. I think de-escalation of the tension and the bad blood is the hope of both sides. Right. But how do they get to that is the big question. If both come in, with their chests out and ready to swing punches, it'll, kind of derail these talks quite quickly. So by Monday, we should have have a better sense, and the markets, to your point, should have a better sense of how successful these were to sort of get dialogue back on the rails, because there hasn't been any dialogue. You have to kind of, I mean, I've heard a lot of comments living in this part of the world, people who would normally be fairly critical of China applauding China's approach to this as basically playing hardball with the Trump administration, not acquiescing to Trump's demands to come to the table and talk and playing the longer game here. Keep in mind, the United States has a lot at stake here. With these tariffs right now, Bloomberg Economics is essentially saying with the tariffs at this level, over the next couple of years, we could see CPI inflation up by 1.7%, GDP growth down by 2.9%. So even if you bring it down to 60% from 145, it's still quite a tax on the U.S. economy at a time when, of course, first quarter was not so promising in the United States.
I mean, it really tells you how far extreme we've gone, that 60% is a good thing.
Well, it's like you walk into the store and say, I'm going to give you half off of this stereo system, which, by the way, we tripled the price last week.
Yeah. There we go, with a bad cassette tape to that. Steve, fantastic. Thank you so much for the great context there from Stephen Engel, and, of course, the latest scoop here out of Bloomberg News. Right, now, U.S. Commerce Secretary Howard Lutnick says tariff deals with Japan and Korea will take what he calls an enormous amount of time. He also spoke to us about the newly announced trade framework with the UK and what it means for negotiations with other nations.
With the UK, again, we had a balanced budget. It was really about our exports. We are not focused in sort of this, singling out China, any of that stuff. That's just not the president's goal. The president's goal is to drive the American economy. Hopefully, the meetings this weekend will de-escalate things and put things back on the right track with China and the U.S. on trade. But our objective with all these countries is whatever rate we set for China should be for the countries that trade with China and send it into us. That should be about the same for those two. That makes some sense. And otherwise, let's grow our exports and let's grow our tariff revenues. Let's grow our exports and let's take this trade deficit down. Remember, if you have a $1.2 trillion trade deficit and you cut it to $900 billion, you only cut it 25%, you grow our GDP 1%. Imagine the guy sitting in the building behind me grows our economy 1%, and then you bring in all these building, right? The trillions and trillions of investment. That's probably going to bring 2 points of GDP. No one ever thinks about the fact that the U.S. our economy grows similar to everybody else. And you know why? Because we export 4 points a year of GDP growth to the rest of the world. When Donald Trump brings that home, you're going to see our economy grow like fire. And that's what he's talking about, and that's what he talked about today.
Well, Mr. Secretary, in your last answer, you referred to a few other trading partners, the European Union, Vietnam. You also called out, is that where we should look to see the next deal emerge, or are we likely to see other partners like Japan and India first?
Well, I think we would like to do one in Asia so we can show that kind of arrangement. We want to do one in Latin America. We're trying to show people a framework of how to do business so that we can roll much more quickly, right? So once you do one trade in Latin America, you do one in the Caribbean, you can then say, look, here's a template. Why don't you all think about it and see, does that work for you? And if you want to modify it, modify it. But then what will happen is we'll do one and then we'll do 10, and then we'll do one and then we'll do 15. Right? And we want to do big, but obviously when you talk about Japan, I mean, come on, you've got to spend an enormous amount of time with Japan, Korea. These are not going to be fast deals. Now, India's been leaning in really hard, right? I love doing a deal with India. That's certainly a possibility, but this is a lot of work. These are a lot of lines.
That was the U.S. Commerce Secretary Howard Lutnick speaking with Bloomberg's Kayleigh Lyons. And just on the topic, and something that's very sensitive to how these trade talks go as well, is, of course, the Chinese yuan. And we are just seeing some weakness this morning in the last couple of minutes.
Yeah, we're trading now at going into weekend talks, right? We're trading now at the weakest level in about 7-8 sessions right now with this recent spike we've seen of late. We'll try and figure this out. Why? Yeah, plenty more ahead. Here, this is Bloomberg. Right, welcome back to shows. Markets are higher, equity markets, and the dollar. We'll get to the dollar later on. So, broadly speaking, we've had a very good, let's call it week and a half, the last 2 days on the CSI 300, maybe following that midweek press briefing, rocketed the benchmark back above Sanpa, which is the 3,800 level. And as you can see, so that the 3,800 level actually has been a very important psychological level. It's been a floor when you look back at the bounce and retracement back in September. And right now, we're now looking at perhaps a retest of the 100-day moving average as we perhaps look at further highs from the current 5-week levels we're in currently. Let's talk about these markets, onshore markets in particular, and what the mood is like on the ground, onshore. Let's bring in Shenyi, CEO at Shanghai Shenyi Investment. Good morning, sir, and thank you for taking the time to speak with us. Why don't we start with what the mood is like on the ground there, onshore, ahead of, well, as the market has somewhat rallied and ahead of trade talks this weekend?
Yeah, I think the mood has been quite optimistic. I think there's two positive sides. One is the trade talk resumed. And the second part is in the last few days, the China's regulators, central banks released a lot of news towards stabilizing the market. Pretty much in US, you call the Fed puts. Now in China, you can call a similar thing, maybe CSRC put. So people felt like the market has been in the process of bottoming. So people are looking for a stock to buy.
And you've also just come back from New York as well. So you've kind of, you've got two different perspectives here. What was the tone that you heard, or the conversations that you had when you were in the US?
Yeah, I think there's we separate the economy and the trade talks. I think a lot of U.S. corporate have expected the basically really high tariff. So a lot of corporate actually have about 3 months inventory on hand. So the production will be in place. I don't think you will see a lot of price hikes either. After 3 weeks, after 3 months, we'll see what happens. On the China side, they are prepared for this as well. So you have a lot of export shipped on the way, and you have a lot of stimulus package release on the way. So I guess in the 3 months' time, both sides will have pretty good economic numbers. But for trade talks, I think even we resume the trade talks, I'm quite pessimistic about the long-term view on the trade talk. I think the part is it's I would say, negotiation tactics. The trade war goes on. I would say the trade war will go on for many years to come. So both sides will pick whatever is favorable to ourselves. We pick the goods. Probably China will pick maybe computer chips and there's some high-tech products to waive the tax on it. U.S. maybe waive the tax on the toys and the daily goods and some of the vitamins, medical products to release the pressure on ordinary people's daily life. But overall, it's a war. I think that trade war will go on. The talk is just a truce during the war.
Yeah, I think you've outlined it very nicely. You think we'll be in a sort of semi-embargo situation over the long term. And again, the importance of divorcing the sort of the economics from market opportunities. If you could talk to us, then, what do you think are the best tactical opportunities right now onshore, given if that is the scenario we're in for the medium to long term?
You mean onshore Chinese market, right? Onshore Chinese market, onshore Chinese market, I think, because as I said, you have the government puts. So people are free to actually do index purchases. So instead of picking on sectors, you probably can buy index ETFs, index funds, and probably you can do the dollar averaging in. So I look at the index. For instance, the CSI 300, I would say during the year, it may have another 5-10% upside. And if it goes down 3 to 5%, you probably should step into the market to purchase it up. You'll be a range bound market, I think. You will not be a bull market, but the market will not crash. At the same time, I would say people are looking for the growth sector. At this moment, I'm not exactly sure, but I do see recovery signs in different sectors in Chinese economy. But I would say at the best, it's stabilizing. We haven't seen like explosive growth yet.
And do you want to look at the US as well? Actually, one of the most read stories on the terminal this morning is talking about Asia's super rich, and they're rapidly scaling back their US exposure. There's even one family office that manages assets for Chinese billionaires, and they've exited their US holdings entirely. But how are you looking at that market?
I think the US market is still a market to invest, but the issue being political and the geometric politics. I believe all the Chinese billionaires will be scared of the current environment. They cut back the U.S. holdings. They move their family office away. I can totally understand their decision. Look at what happened between Russia and Ukraine. And the U.S. regulator are constantly talking about delisting Chinese-related stocks, put extra tax on the foreign investors' holdings, not just stock, maybe even treasuries, and probably confiscate some of their holdings. Under that kind of pressure, I would say that will influence people's mentality greatly. They probably can move the money away until the environment have a clear sign of a stable political and economic policies.
Yeah, and Shenyi, amidst that, amidst, let's say, the peeling off of U.S. exposure, U.S. dollar treasuries, you talked about that. One place that's emerged, and not because I'm here or we're here, but you really see that in the commentary coming through, is Hong Kong, right? So Hong Kong, you have the big Chinese tech names are here. It's a possible location if indeed you have these delistings in the U.S. It really is a homecoming venue at that. What's your sense of, and we have a number of IPOs and trading debuts that we almost report on almost a daily basis here in Hong Kong. What's your sense of the onshore-offshore dynamic here?
I think Hong Kong will be a very, very hot IPO market in this year, maybe the years to come. Not only all the U.S.-listed Chinese companies will do listing in Hong Kong, prepare for the possibility of a delisting in U.S., and also a lot of onshore Chinese company will get delisted in Hong Kong. So in the last few years, most U.S. investment banks are cutting back IBD department of staff. I think it's the right time for Goldman Sachs to beef up the team.
Shenyi, that was the CEO there at Shanghai, Shenyi Investment. Thanks so much for your insights this morning. And coming up, we're going to be taking a look at China's consumer sector, speaking exclusively with the CEO of Chinese apparel brand, that's Urban Revivo. It's being called a Zara competitor, but we'll hear why they're committed to global expansion plans in the US and European markets despite all of this tariff uncertainty. But we'll have plenty more ahead. This is Bloomberg. You're watching The China Show, and some of the corporate stories that we're tracking this morning. OCBC's first quarter profit exceeded expectations. That was driven by strong wealth fees, trading and insurance income. Net income was 5% lower at $1.45 billion. The bank also maintained this year's outlook, expecting loan growth in the mid-single digits, as well as a 60% total dividend payout ratio. Nintendo shares have reversed early gains in Tokyo. That's after the company projected weaker than expected initial sales of the Switch 2 amid tariff uncertainty. It expects Switch 2 shipments of 15 million units in the year to March, well short of the 16.8 million average analyst forecast. Nintendo's annual operating profit prediction of $2.2 billion was also below expectations.
Okay, let's get you through, speaking of earnings, there are a lot of big equity movers here on the back of some earnings coming through across the region. Japan and Oz, say at Macquarie, they're up 5% now. Yeah, profit topping estimates there. There's also this whole list of Japanese companies reacting quite positively, as you can see. Ceramics maker, of course, 17% to the upside. Kao is up the most since, I think, Corona hit back in March of 2020. That's also an earnings story. The fourth one on your screens is also something similar. We're looking at Renite Corp here. Receiving a share proposal, in fact, from Dodson. We're looking at a buyback, earnings coming through, and also an announcement from the company. It will be retiring all shares bought back on December the 15th. Very quickly, Nidec withdrawing its takeover bid for this company, and shares, as you can see, are withdrawing from gains we've seen in recent days. Plenty more ahead.
It's 11:29 a.m. in Tokyo. We've got Japanese markets here just a few seconds away from the lunch break. Today, you're seeing broad optimism, and for Asian equities generally, you can see there, but it's really being led by what's happening in Japan. And overnight, we had the US and the UK announcing a trade deal. This is playing into the sentiment we see for Japan in particular, because investors, of course, are thinking, OK, that's maybe a litmus test for how other negotiations proceed. It's interesting, though, because we had the interview with the Commerce Secretary, Howard Lutnick, who also acknowledged, actually, the trade deals with South Korea and Japan are going to take significantly more time to complete than the framework agreement with the UK. But still, I mean, you've got that optimism, you can see.
If those two take long, you can just imagine how much the big one takes, how much time the big one will take. The one with China.
The big one being China,
with China, sorry if I wasn't obvious just there. Yeah, that's the big one coming up over the weekend. I think, as far as markets go, you had a big spike in yields yesterday going into this morning. You're seeing a bit of a reversal there on the U.S. 10-year. The 2-year actually spiked quite a bit. The 10-year yield in China, 164, was, I think, our high this week. 158 is your record low. And the reversal of Asian FX strength, which have come through. Now, I think when you look at dollar China, for example, it's near session highs, and really the dollar has been somewhat on the front foot this week. It's been an eventful week. Everything from the Friday and Monday in the Taiwanese FX markets, the successive lows that we've hit on HIBOR here in Hong Kong, massive plunge that we had, I think, on Wednesday, biggest drop in 17 years on 1-month HIBOR. We had a further drop on Thursday. We're looking at that as well going into the next hour. And, of course, on the 3-month CNH HIBOR, actually at a record low here in Hong Kong, I guess indicative of all this liquidity and maybe as a function of all the intervention that's taking place on the Hong Kong dollar from the HKMA. Let's talk about the implications and what happens there with Ju Wang, head of Greater China FX and Rates Strategy at BNP, here with us on set. Nice to see you as we wrap up a manic week. What do you think is the biggest FX story this week?
Well, it's certainly Taiwan dollar followed by the Hong Kong dollar points. The movement is dramatic. It's definitely exceeded everyone's expectation. It is interesting in the way it happens at a time when people start to talk about long-term de-dollarization trend. Of course, everyone understands for the very near term, there's still a problem of lack of alternatives, lack of assets outside of the U.S. market. But people also, acknowledge that the U.S.'s net international investment position is $26 trillion US deficit, right? So the whole world is being long U.S. assets for decades. Right. So if that position start to think about either adding some FX hedges, the movement can be dramatic. So that explains why there's such a dramatic happening in Taiwan and Hong Kong, because these are all the economies that are holding massive dollar assets, probably not enough FX hedges in the market.
I think the last time you were here, it was the start of the de-dollarization story, right? And I think that you mentioned something back then that you've never gotten as much questions about the dollar in your entire career. And yet here we are, and we're getting pockets of examples of how it doesn't seem the system is built for this quick of, a unpeeling of the dollar. Do you think we'll get more of these episodes coming up?
We actually think for the very, very near term, the dollar should stabilize already. There are a couple of reasons. I mean, Asia market, they all look at central bank signals. We know China fixing's been very stable, above 720. Today, it was a little bit higher, probably 22 pips higher. Taiwan, I think, on Monday, and then in following days, the authorities have come out in various circumstances trying to dismiss the speculation that the currency is part of the trade talk between Taiwan and the U.S. And the market take that as a sign that the Monday low at 29.6 is a near-term line in the sands for dollar Taiwan. And in Hong Kong, we all know 775 for sure, HKMA will step in. And the points was so negative yesterday. So even though for the past few weeks, we've already warning the risk of a collapsing of a long-end dollar Hong Kong points, because we feel the last time we saw the concern about the U.S. twin deficit was in 2005 to 2007. That was also a time when the dollar traded very weak, despite of the high yields advantage versus Asia currencies. And back then, the common symptom shared by the surplus Asian currency is very depressed FX points. Because the spot, there's a limit, because a lot of Asian currencies have intervention, have a band like a Hong Kong dollar. So any fear about a weak dollar will be reflected in the forwards. So that explains the collapse in the long end points in Hong Kong. But at current level, we think the points are so low. So yesterday, the overnight dollar Hong Kong Topniks essentially implies overnight raise in Hong Kong about only 40 basis points. That's nearly 400 basis point difference from the U.S. overnight raise, right? That is a bit too much, given we still believe the peg will stay. The arbitrage mechanisms over time will come back in and stabilize the market.
Yeah, that's what I want to ask about the peg, because, of course, when you see these sorts of moves, you also start to get questions around whether it would be sustainable or whether it would be sustained. Do you see any sort of outside risks to that?
We think economically, having a peg against the dollar is still the best arrangement for Hong Kong. Currently, there's no better alternative. The renminbi is still not fully convertible yet. And globally, I think the investors still value the dollar as a reserve currency, as well as a storage of value in terms of investment. So we feel there's no reason for Hong Kong to choose to depeg from the dollar. From an economic perspective, Hong Kong is still having a bit deflationary concern due to the linkage towards China and a weak property market earlier. So now have a dollar Hong Kong trading under 775 and in liquidity injections due to HKMA intervention. That's actually very good for Hong Kong financial market and the property market. So there isn't much concern why they cannot keep doing this. And the current aggregate balance, yes, it tripled from the lows, but it's still far away from the historical high levels.
Yeah. Well, we like to ask about it because it's not news most of the time. So when it happens, so we take that excuse. So Eddie, I'm sure he's a bit tired of getting that question recently as well. I take every opportunity to ask him whenever we talk with him. I want to ask you now. So we've had this briefing this week out of monetary officials. Was there anything new in your view, anything substantial in your view?
Actually, the market take it as in line with expectation, this week's briefing. I mean, the officials are all very senior levels, right? Head of PBOC, et cetera, et cetera. I mean, it does show that they're fully committed to keep a stable markets, right? They're saying we want the currency, the bonds, and equities being stable. And despite of this huge challenge from tariff side, I think the commitment for that is still real. There's a lot of mentioning about equity markets, and that I think definitely show the commitment to keep the market stable despite of the external challenges. But at the same time, we also acknowledge that overall the trend is following the so-called 90-degree turn since the September meeting last year, i.e. they definitely turned more pro-consumption, pro-house market, etc., etc. But the pace is still measured, right? They cut 25 basis points for the house provident funds. It's larger than the 10 basis point OMO cuts, but still 25 basis points it's not huge. They're announcing more funds for consumptions and services and elderly cares by 500 billion. But at the same time, they also have that 800 billion of funds, renminbi funds for the technologies. So there's a still fine balance between more near-term growth on the consumption service side, but still a medium-term focus on on the high quality and technology-driven growth model, in our view.
So we're going into the negotiations between the US and China, and we've been speaking this morning about how important the tone is going to be. Maybe we won't get anything concrete out of it, but at least it will sort of set the I guess the tone again between how we expect the negotiations to play out. But what are your expectations around that?
We actually think this week is more about de-escalation. But our base case is that the deal between US and China is still going to be one of the latest one. So more likely towards the end of Q2 rather than this weekend. The thing that the market is debating is that I do think the market believes eventually there will be a trade deal. There will be a rollback about tariffs because current level simply is just not sustainable. Yeah. But the market doesn't know whether the end tariff level on China is whether it's 50, 60%. Or further lower to the level prior to the liberalization day.
Right. Take your time. Take your time. Yeah, but I think the market that we've been trying to figure out is because equity markets have almost reversed all the losses since then. Although some of the measures of, say, the MOVE index, the FX volatility, they've remained quite substantial, and I wonder. Are we going to be stuck with a premium on these markets for months to come, for the foreseeable future, you think?
I think the market will continue to trade with extreme bearishness, extreme optimism, and the right strategy is to fade the extreme kind of views and positioning in the market. For the very, very near term, I do think the market is a bit overly bearish on the dollar, and hence it's rebounding, and that's fully understandable given the positioning, given the Asian central banks following the market. But if there's an extreme bearishness on the other side, for example, when the RMB is above 730, certainly you see guidance from the other side, and the local exporter will take the opportunity to offer dollar. So definitely just fade the extreme move is the right strategy in this kind of environment, in our view.
Ju Wang, thanks so much for joining us this morning. That was Ju Wang, their head of Greater China FX and Rate Strategy at BNP Paribas. But up next, we've actually got a very interesting interview. This is an exclusive one. It's with a Chinese company. It's been dubbed sort of the Zara of the mainland. This is Urban Revivo, but they're very committed to global expansion plans despite all of this trade uncertainty, but looking to the US, looking to Europe as well. So we're going to have that interview ahead. You're watching Bloomberg. Well, luxury labels like Balenciaga, Versace, Valentino, I'm sure really the vast bulk of your wardrobe, Dave.
Everything. Top to bottom.
Everything is top tier fancy. Yeah. Anyway, they're going to be reducing or eliminating their discounts on Alibaba-owned e-commerce platform Tmall. Now, this is a strategy that signals a shift away from chasing short-term revenue. But let's get more with our consumer reporter, Shirley Zhao, joining us. So, Shirley, very interesting pivot. Why are the brands making it right now?
Yeah, so last year we wrote about all the brands that you mentioned just now were offering steep discounts and sometimes more than 50% on Tmall, which is China's dominant e-commerce platform. And recently we've obtained data showing that these brands are either lowered the levels of discounts they're offering on Tmall or have stopped doing so completely. For example, Balenciaga hasn't offered any discounts on Tmall throughout the first quarter. And they're doing this because discounting is proving less effective in China right now. China's middle class are becoming more cautious and selective in spending, and they're no longer attracted to discounts. And discounting also risks damaging the luxury brand's premium exclusive image, and that may alienate them with their premium clients whose spending power remains strong. So that's why luxury brands are doing this, to elevate their brand image and make them to be more appealing among China's richest customers.
And it's a shift away, as I think Belle was pointing out, the shift away from just the focus only on just short term. What is the significance of that, do you think?
Yeah, so analysts are saying this is a foundational change in luxury brands' strategy in China. So they're moving away from just chasing short-term sales to focusing on building brand relevance and premium experiences for customers, which will allow them to grow more sustainably in China over the long term. And this also reflects their understanding of Chinese consumers' changing perception on luxury. Chinese consumers are no longer buying luxury just for the brand names. They're seeking something unique. They're seeking unique shopping experiences. They're seeking personal level connection and identification with brands. So luxury brands really need to move away from just focusing on their pricing strategy to focusing more on providing these unique experiences and building personal level connection with consumers.
Shirley, thank you so much. Fantastic reporting.
Thank
Shirley
you.
Zhao, our Bloomberg Conglomerates, Consumer and Gaming reporter there. Let's stay slightly on theme here. So you have Chinese apparel brand Urban Revivo says it is committed to its global expansion plans in the U.S. and European markets despite the hit to margins from the tariffs from the White House. Now, the founder and CEO, Liu Li, told us exclusively how the Zara, I think of China, is how they're being framed is weathering this trade storm.
Tariffs do have some impact on us, but we haven't raised retail prices as there's still a lot of room for us to bear the tariff burden compared to other local brands. We will revisit this decision based on future policy changes. Our supply chain so far is 100% in China. In the future, we may build supply chains in Turkey and Morocco, but we will adjust the plan based on the change of tariff policies.
You have a pretty aggressive expansion plans. You're planning to open 25 new stores overseas this year and planning to hit 100 stores next year. Has the current tariff war changed your plans or made you reconsider your focus maybe away from US to other emerging markets?
Our goal is to open 200 overseas stores in the next 5 years. While we may adjust this plan for the first 3 years based on the global market changes, but we will adhere to our original blueprint. We want to use American and European markets to establish our global brand and make an impact on global markets.
Are you basing your U.S. expansion plans on the assumption that tariffs are going to come down? And what are your expectations as U.S. and China head into trade talks this weekend?
I think U.S. tariff policies will impact our pace of opening new stores in the country. But our long-term plan for the U.S. market remains unchanged, as we believe it's a very big and important market. We are committed to succeeding there from a 30-year to 50-year perspective. I'm not an expert on tariffs, but I think the impact won't be too severe. The tariffs are likely to be reduced. It's a matter of how much. I'm optimistic about future changes in tariff policies.
Let's talk about your domestic market. You have about 400 stores in China. What is your sales forecast for this year, given the broadly weak consumption sentiment? When do you see consumers coming back in full force?
Chinese consumers are now more prudent. They are increasingly price sensitive. Over the past 2 years, we have made several innovations, including adjustments to our products, brand positioning, and pricing.
We've reported that you were planning an IPO and planning to raise about $100 million. Is that still in the pipeline, and what is your timeline for that?
This is still in progress, but there isn't a specific timeline yet. We believe this is definitely a direction we will pursue. IPO is a very important milestone in our company's development. We will make decisions based on the company's situation and the market environment. It will most likely be in Hong Kong.
Right, welcome back. Let's talk about the marriage rate in China. So we talked about the demographic challenges there and certainly less and less people getting married. Well, the rate has actually tumbled past tense to a record low last year, adding to this crisis that's been spiraling since the now abandoned one-child policy. Our China correspondent Min Lo reports that Beijing is scrambling to offer incentives for people to get married and to have kids, but their efforts have so far have had limited success.
A free cup of milk a day, up to $13,000 per newborn child, even a marriage school promoting slogans like, "I'm willing to make breakfast, I'm best at doing housework." These are some of the measures local governments in China are trying to boost the dwindling birth rates. The number of marriages in China dropped to 6.1 million in 2024, an all-time low and down 21% from the previous year. China's one-child policy accelerated the pace.
Japan currently has 1.2 children per woman, but China currently has only 0.9, and it will decline. So China's decline speed is much faster than other countries.
At this marriage market in Beijing, parents are anxious to find a potential mate for their adult children. In China, owning a house and a car is often a prerequisite. But many young people no longer want to subject themselves to the financial pressures of getting married and raising children.
For me, buying a house in Beijing is the biggest problem, because personally, I don't want to settle down in Beijing, because living here is really stressful.
Abigail has been running a wedding planning business for nearly 2 decades. She's witnessed firsthand the hit to the now $400 billion marriage industry.
Our peak was probably in 2012. In that year, we probably handled more than 1,800 weddings. Now, most companies, including ours, plan about 100 weddings a year.
Higher educational levels also mean marriage is no longer the default rite of passage to adulthood.
I feel that among the newlyweds who are having weddings nowadays, I can say that half of them are forced to do so, trying to meet the needs of their parents.
And while marriage rates decline, divorce rates have been climbing. This firm started a business getting rid of personal effects to protect privacy. But the demand for destroying wedding mementos, like albums, dresses, and even rings, soon took up 90% of their sales.
We have now served over 5,000 customers, with a daily volume of around dozens of orders.
Beyond the wedding industry, analysts warn that declining birth rates will have important implications for China's retail sector.
The biggest consumer is children. It's a biological instinct for parents to spend money on their children. Therefore, the more children there are, the stronger their consumption power will be.
That's one reason the Chinese government is pledging childcare subsidies and free preschool education to boost the birth rate and reduce the demographic drag. Whether or not these incentives will be effective remains to be seen. But analysts expect more nationwide fertility benefits to be rolled out this year. Min Lo, Bloomberg News, Beijing.
Yep. Okay, there we go. Some trends to track moving forward. Other things to do into the next hour, right? Property stocks are on the way up. That has to do with maybe HIBOR rates coming down. That's going to help mortgages, that sort of thing. A lot of liquidity in the system. Chris Wood out of Jefferies calling this maybe a likely bottom to the property market. So watch the HIBOR rate in the next hour. Other things to watch as well going into the weekend.
Well, it's interesting because you've got stocks that are broadly high today in the session. This is all this anticipation around the trade deal, particularly what's been signed so far between the UK and the US. You come in on Monday and, you know, who knows exactly where the tone's going to go. But we've got the US and China kicking off their negotiations on the sidelines of Switzerland. So something we're going to be reacting to very, very closely. But taking a look here, we've actually seen mainland stocks pulling back a little bit. That's the final picture here. Happy Friday. Be back with you on Monday. More ahead.